Hello, everyone. Thank you for coming. I would like to thank Peter for organizing the uncertainty session, and I appreciate this great opportunity to present my work. The title of my paper is Embrace of Fear Uncertainty, Growth Options, Limited Risk Sharing, and Asset Pricing. In this paper, I address a fundamental question in asset pricing and macroeconomics. The question is, how does uncertainty affect asset prices and macroeconomic dynamics such as investment dynamics? Before answering the question, let me give you a rough yet intuitive definition what does it mean by uncertainty in this paper. It means the blurriness or randomness of firm-specific economic prospects. In the literature, it's been called micro-uncertainty, as in Bloom 2009. Let me be more specific. What do I mean by uncertainty? Here, actually, I mean the volatility of idiosyncratic shocks. It is different from the uncertainty, other concepts of uncertainty in the literature, such as Knightian uncertainty, which means unknown unknowns, or the macro uncertainty, which means the volatility of aggregate shocks. The literature on there has been a substantial yet fast-growing literature on micro-uncertainty. Early works focus on qualitative analysis, and building on those qualitative intuitions, more recent work has shifted to the quantitative studies. The consensus in the literature is, okay, micro-uncertainty, the uncertainty shocks does have first-order aggregate implications. However, what is still puzzling is we can see in the data, sometimes the impact of uncertainty is positive, while other times it is negative. And also, it is still unclear what is the factor that determines the sign of the impact. In this paper, I try to address the question whether the opposite effect can be quantitatively reconciled in a coherent framework. And within this framework, can we sort out what are the first-order factors that determine the sign of the impact? As a main contribution, I developed a general equilibrium model with heterogeneous agents and firms with financial friction. It shows that the impact of uncertainty shocks depends on two important factors. Okay, one is the risk-sharing condition in the economy, and the other is the source of uncertainty. As for the risk-sharing condition in the economy, empirically, you can think it can be captured by the financial condition, empirically, okay? Because since by design, the financial sector should play a vital role in facilitating risk-sharing between different agents in the economy. And we know the financial condition fluctuates dramatically over time in the data. It can be as good like in the 90s, and it can be very poor like in the late 2000s. As for the source of uncertainty, in this paper, I focus on two major sources of uncertainty faced by managers and investors. The first source of uncertainty is about the uncertainty of the quality of the investment opportunities in the near future, which I call investment uncertainty. And the other type of uncertainty is more traditional uncertainty, which is the uncertainty about productivity in the short run, which I call productivity uncertainty. So the second type of uncertainty is actually people have studied extensively in the literature starting from Bloom's paper, 2009 paper. What is new in this paper is the first type of uncertainty I call investment uncertainty. Okay, before jumping into the details, let me give you a model overview. First, let's zoom in on a single firm. So for each single firm, the firm produces consumption goods using assets in place, such as machines. And the productivity of those assets in place is stochastic. And its firm-specific randomness is called productivity uncertainty. And at the same time, the firm creates new assets in place using growth-related assets, such as blueprints. And the quality of these investment opportunities is also stochastic. And this firm's specific component, randomness, is called investment uncertainty. Okay, simply put, the productivity uncertainty is directly associated with assets in place. Well, the investment uncertainty is directly associated with growth-related assets. Okay, now let's jump out, take a look at the bigger picture of the model and the main mechanism in the paper. So we start from each firm. Each firm is controlled by a manager. And the manager must maintain a non-diversified ownership stake in the firm. And this kind of concentrated ownership constraint can endogenously arise from incentive constraint of moral hazard problem faced by the outside investors and the managers. And the managers and the rest of the shares of the firm, each firm, is sold to the diffuse shareholders, who are households in the economy. Okay, and because the managers, the talent of managers, assumed to be scarce, in the economy, and they are risk-averse, and they are forced to bear idiosyncratic risk. So the diffuse shareholders find it efficient to deliver or to transfer rents, to pay rents to the managers as a compensation, actual compensation. And the rents, most importantly, the rents, the diffuse shareholder agree to pay to the insider, the managers, is state dependent, depend on the aggregate states. More precisely, later you will say they will affect by the uncertainty shocks, both investment uncertainty shock and the productivity uncertainty shock. Because of this, those diffuse shareholders have strong incentive to go into the derivatives market, for example, to hedge this type of exposure, unpleasant exposure to the uncertainty shocks. Okay, so when the financial sector condition is good, which means the hedging cost is low, then the risk sharing, the diffuse shareholders are more willing to provide equity fund to the firms. However, when the financial condition become worse, which means the hedging cost here is high, okay, so the shareholders, they feel less willing to provide equity funding to the firms. So this is a main mechanism. At the same time, the investment uncertainty also affects managers' investment opportunity set. Why that's the reason? Because remember here that we have growth-related assets. So effectively, the managers are holding call options. So when this investment uncertainty is high, their investment opportunity set got improved. So in this paper, this paper is about these two opposing, competing effects. So we'll see how these competing effects affect firms' decision, affect asset prices, and how they compete with each other. And simply put, so the model incorporates financial frictions due to moral hazard, like Holmstrom Tyrrell 1997, and the lumpy investment based on growth options, like, as in passed over Varanasi 2006, 2009, into otherwise very standard production-based asset pricing workhorse, like in Gomez, Kogan, Jiang 2003. Okay, benchmark model. The first benchmark model is a model, frictionless model, in which you will say the investment uncertainty will always be good. The production is standard Cobb-Douglas production plus one idiosyncratic productivity shock. And the key FT is the installed assets in place. And the LFT is the labor demand. And this AFTP is the idiosyncratic productivity shock. The volatility of this productivity shock is in the model is what we call productivity uncertainty. Okay, this is the key, one of the key term quantity variable in the model. And the old assets in place depreciate with constant rate delta plus a stochastic term. So the new assets in place is created from SFT, which is growth-related asset. You can think of them as blueprints. plus GFT. GFT is like investment goods, like raw materials, using also according to a Cobb-Douglas production function. And the outcome of these blueprints, subject to this firm level of firm-specific idiosyncratic shock, DAFTLI. So this is a firm-specific shock of marginal efficiency of investment. Okay. And in the economy, who is the supplier of the investment good? Here I use the simplest model tool. So basically, I assume there's a representative investment goods firm who produce investment goods using labor as input in the linear production function. Okay, so this firm-specific idiosyncratic investment shock has two components. So the first one is DMFT. DMFT characterizes the arrival of investment opportunity. All you can think is like business idea to convert the outcome of blueprints into profitable machines. Okay. The firm F receives one investment opportunity if and only if DMFT equals to 1. The intensity of the Poisson process, MFT, is mu. And the other component is the epsilon FT. Right? This is the quality of the investment opportunity. Given the firm receive one investment opportunity, the DMFT equal to 1. And still, how good this investment opportunity is characterized by epsilon FT. Right? Okay. And the standard deviation of epsilon FTI is what we call in the model, what we call investment uncertainty. Okay. Okay, so the net profit of the optimal investment has a standard call option payoff structure. So it's a positive part of this profit, net profit. The net profit is the value of total newly created assets in place minus the cost of investment goods you used to produce those new machines or new assets in place, and minus this fixed investment cost. As a result, the firm level optimal investment rate can be decomposed into three parts very intuitively. The first part is, okay, the DMFT, which means whether the firm receive investment opportunity. The second part is indicator function. It's 0 or 1. It is given the firm have this investment opportunity, the manager will decide endogenously whether they will implement this investment opportunity or not with this endogenous exercising boundary psi t. And the third term is actually the standard Q theory term. So basically, it's increasing with the value of assets in place. Okay, so aggregate investment rate IT is the aggregate total newly created assets in place divided by the total old assets in place and normalized by the time interval. In the equilibrium, the optimal investment rate, IT, will increase as investment uncertainty increase. Okay, in this sense, this investment uncertainty is just like an aggregate investment shock. Right? So it will boost up the investment. It's good for the aggregate investment. Why that's the case? This is actually through the so-called option effect. Because here in the equilibrium, the aggregate investment rate has these two components. One is this Q theory part. The other is effective marginal efficiency. And this effective marginal efficiency has two parts. The intensive part is increasing in the investment uncertainty, and the other part, the extensive margin part, is also increasing with this investment uncertainty. They are all very intuitive. Let me explain one by one. So this intensive margin, why is increasing with investment uncertainty? Because when investment uncertainty becomes bigger, and for all firms, you have a larger likelihood to get extremely good investment opportunity, right? So the intensive margin becomes bigger. And for the extensive margin, it's also intuitive because when the investment uncertainty becomes bigger, the dispersion of the existing investment opportunities become bigger. So more firms receive good good investment opportunities whose quality is beyond this exercising boundary. So that's why both intensive and extensive margin increase with investment opportunity. Actually, this is the option effect. Okay, so if you look at the agents' portfolios, all idiosyncratic risk will be diversified away. So everybody is like, there's a representative agent who is holding the market portfolio. And now the model just go back to the standard macro model with aggregate investment shock. So now this, the investment shock is the investment uncertainty shock. So let's go back to standard model like GHK model and the Papanicolaou 2011. And in this case, when ES is bigger than 1, so we can say this investment shock not only increased aggregate investment, at the same time it carries a positive market price risk, which means in terms of asset pricing is also a good shock. Okay, so now let's move to full model. Full model, the only thing added on the baseline model is the key is the non-diversified idiosyncratic risk borne by the managers. In asset pricing literature, we call it background risk. The macro foundation, one macro foundation for this non-diversified idiosyncratic risk beared by the managers or background risk is managers' moral hazard problem. As a modeling shortcut, so I just model simply say this, the managers, they can steal cash or investment opportunities from the firm secretly. And their short-term contracts, and the outsiders and the insiders, they contract using short-term contracts and embed those ingredients into a dynamic GE framework. One important feature is the stealing here is standard in the literature. Stealing is inefficient because it incurs deadweight loss with the efficiency parameter phi. Okay, given this setup, we'll achieve very standard optimal payout compensation contract. We have two components, slow and level. The slow is the exposure of managers' payoff, compensation to the firm-specific idiosyncratic risk. And the level component is the required risk-free rents transfer by the insiders, by the managers. Okay, given this, so what's the deviation? Given this restriction, constraint, incentive constraint, and a non-diversified ownership stake for the managers, so what is deviation from the benchmark model? The simplest way to see it is through their optimal portfolio holdings. So let's first look at managers, which means here, that's why I'm here. So for managers, they are holding market portfolio like before in the benchmark model. But on top of that, they are forced to exposed to this idiosyncratic shocks, idiosyncratic risk. And because they are forced to hold this idiosyncratic risk as part of an optimal contract, they require this rents transfer. And importantly, this rents transfer is state dependent. And their effect, they are driven by the uncertainty shocks. So they will hold a large hedging position to hedge the risk because due to this rents, state-dependent rents. Okay, so this is a deviation from the benchmark model. And if you look at household, they are also holding market portfolio, and on top of that, they pay rents to the managers. And then because the rents they're paying is state-dependent, in the model, they are mainly driven by the uncertainty shock, so they're also holding huge hedging positions. So the key mechanism here, in the full model, what's new here? What's new is the so-called risk-sharing channel. So basically, the key mechanism of this risk-sharing channel is the state-dependent rents that's affected by the uncertainty shock. That's it. So in the model, if we, under my bench calibration, I solve the model. So basically, you can say this is, in the plot, the panel A is about rents of holding assets in place. The panel B is the rents of holding growth-related assets. And the x-axis is the net worth share of the managers. As the net worth share become bigger, the risk-sharing condition is better. When net worth share is smaller, the risk-sharing condition is worse. And this distribution is a stationary distribution of the economy in the equilibrium. Let's look at the panel A first. So the red solid curve is the rents, equilibrium rents in the low uncertainty states. And we can see when uncertainty increase, for both productivity uncertainty or investment uncertainty, the rents goes up, especially for productivity uncertainty, for the rents claimed on assets in place. And here for rents of holding growth-related assets, we can see also as the uncertainty goes up, the rents, required rents also goes up. The increase is especially large when the risk-sharing condition becomes worse, when X becomes smaller. Okay. So here in the model, now we see two channels. One is the investment channel we already see in the benchmark model, and the actual channel which we see in the full model due to the financial friction is called risk-sharing channel. So in this full model, it's all about these two channels competing with each other. So how to say it analytically? So actually in the model, the investment channel can be characterized by the marginal value of wealth of the manager, which is zeta Tm, and we take log, which is omega t. So this omega t is increasing as investment uncertainty goes up due to the option effect, and is decreasing as with productivity uncertainty, which is due to risk effect. And then the risk sharing channel can be characterized by the investment environment gap between the household and the manager. So analytically, you can think in the model, there are the difference between the marginal value of wealth for household minus the marginal value of the wealth for managers. Actually this measure, you can think of this measure captures this market incompleteness in the economy. And this theta t decrease when investment uncertainty goes up, and also decrease when productivity uncertainty goes up. Both are due to the risk effect. So this is in the model, how we solve it. We come to confirm the result here. So you can see for the panel A is for investment channel, it is omega. Basically, the red solid line is the omega for the low uncertainty state. And when investment uncertainty goes to high, this goes to new IH. So you can say the omega increase, which means the manager's investment opportunity increase. And when the productivity uncertainty increase, it decrease. Okay, which means it hurts it kind of compromises the investment set of the manager. And for risk sharing channel, for both uncertainty increase, it goes up. For the gap become wider as both uncertainty increases. Okay, so to see what are the asset pricing implications of these two channels, it can be seen clearly through this CAPM framework. So according to CAPM framework, any excess return here can be decomposed to a standard CAPM excess return term plus the term due to the hedging motivation for the investment uncertainty shock and the hedging motivation for the productivity uncertainty shock. And the risk premium of the investment uncertainty due to hedging, which is this part, is proportional to a combination of the risk effect through the risk sharing channel and the option effect through the investment channel, which is positive, and the risk effect is negative. As you can see, as xt goes to 1, this term goes to 0. Okay, this term goes to 0, so the whole risk premium will be this positive option effect term will dominate. So the risk premium will become positive. And when the xt goes to 0, this term will dominate. So the risk premium for the investment uncertainty will become negative. So the risk premium of productivity uncertainty due to hedging is much simpler because for both, it's always negative through both channels and due to the risk effect. Now, last, let me go over some of the quantitative results in the paper. So basically, I calibrate the model to match the macro moments and see whether the model produce reasonable, consistent asset pricing moments. We can see actually the model is able to produce high equity premium and the equity return volatility and a high value premium and a low and stable interest rate. And one of the major prediction of the model is the investment uncertainty carries positive risk premium when the risk sharing condition is good and carries negative risk premium when the risk sharing condition is poor. Okay, so this is a solution of the model. Let's focus on this investment. The panel B is for productivity uncertainty. It's simple. So basically, we can see the risk premium is always negative, which means the productivity uncertainty is always bad in terms of asset pricing. And the panel A is for investment uncertainty. It's cross this 0 line. When x is high, it's positive, and when x become low, this line, risk premium for different states, they all become negative. Okay, this is one of the main prediction of the model. And the empirical, actually this prediction is supported by empirical evidence. So this table, what we do is we saw the firms according to their beta on uncertainty shocks. And also, so here, each cell is the average return. It's the average return according to the low beta, high beta. And we focus on the high minus low, which this row and this row. So you can see this, you can view this as estimates of the risk premium for the uncertainty shock. And also, we divide the sample into poor risk sharing conditions subsample and the good risk sharing condition subsample, right? But in order to divide this sample, the whole sample into this 2 subsample, we need a measure for risk sharing condition. So here, panel A, I use Reinhardt-Rogoff index as a measure of risk sharing condition, and panel B, I use a broker leverage, dealer leverage index as the financial condition measure. So we can see actually for productivity uncertainty, for no matter it's good or bad risk sharing condition, the risk premium is always bad, and it's very robust across different measures of the risk financial condition. However, interestingly, for the investment uncertainty, the risk premium can be positive when the risk sharing condition is good, and it becomes negative when risk sharing condition is poor, and the pattern is robust across different measures of the financial condition. Okay, now let me conclude. This paper shows that the impact of uncertainty shocks depends on 2 factors, the source of uncertainty and the degree of risk sharing. And the model provides a quantitative framework in which we can reconcile this opposite effect of the uncertainty shocks. And we show that the net effect of uncertainty shock is really predictable. And also, the model provides an uncertainty-based asset pricing theory, which can explain the equity premium puzzle, value premium puzzle, and the interest rate puzzle at the same time.